Good morning, Bowtie Nation. Joseph Hogue here. Thank you for joining us for another Monday market update, 9 a.m. Eastern, every Monday morning. Get you ready for the week. Stocks to watch. Got a great video for you this week. Even with the weakening economy and promises from the Fed for still higher rates that could bring the overall market down over the next couple of months, the market is still giving us some great opportunities in individual stocks. Stock market investors punishing any company that can't beat its earnings expectations, leading to huge sell-offs. Sell-offs like the EV stocks getting hammered over the past couple of weeks. Rivian down 18% alone on its earnings. Newmont Mining, the world's largest gold producer, down 16% over the last month. And today's topic, a medical properties trust, ticker MPW, down over 20% since mid-February on its earnings crush, rebounding 7% since Wednesday. I actually bought in $20,000 over the last week, doubling my positions on some great fundamentals for this stock. I want to talk about that. Stick around after that, though. We got a market update for you, the stocks to watch this week, the economic news, got that jobs report on Friday, and some very important stuff to talk about. Before we get started, I do want to highlight a special offer for Seeking Alpha for its premium access. I've used it for over 10 years for its research tools, some of the earnings reports, and screening tools. Now get it for 58% off. That's about $8 a month, $99 a year. That's save more than $140 off of this. It is the lowest price you're going to find on the internet. In fact, it's lower than the price I paid for premium access when I started. Click through the link below. I'll leave below, and you're gonna see, scroll down here. You're gonna see all the extra tools, extra analysis that you're going to get with that premium access. So click through the link below, check that out. I do want to get to today's topic though, because I believe it's one of the best opportunities in the market this year. Real estate stocks have gotten crushed over the last year on that increase in interest rates. You can see here on the sector tracker, real estate stocks down 16.3% over the last year. That is the second worst performing sector after communication services with 18% loss. And healthcare REITs have gotten hit even worse as those Medicare and insurance reimbursements have just failed to keep up with inflation. That and the higher wages from the nursing shortage have just meant that hospitals are dangerously close to the red. That's led to a halving. The stock is down more than 50% in shares of medical property trust, ticker MPW, since last year. Stock fell another 5% in its earnings last week. I took advantage of those lower prices to more than double my position last week. You can see here my individual 401k, one of my retirement accounts that I control here, and we can talk about why you want to prioritize your high yield dividend stocks in retirement accounts. But you can see in here the 23rd adding 500 shares, the 24th adding another 1,500 shares with some call options against that to hedge the risk a little bit, but adding more than $20,000 into that account last week on those lower prices. Why did I more than double my position, and what do I think the market is missing here? Here, I first want to look at the downside here, okay, why the shares are down and what the market does see here. I think it's very important to start with that downside. Anytime you're looking at a case of the bear case, I think it's important because all too often investors tend to just avoid or neglect that other side of the argument. They have a tendency to ignore the risks in the stocks they own, get too emotionally attached and involved in their stocks, and just don't even want to hear the other argument. Okay, even if it's unconsciously, investors just tend to look for the analysis that's going to support their own opinion while avoiding anything contrary. So it's always a good idea to consciously look and seek out that contrary, that other opinion, that other side of the approach. Again, here we can see that real estate overall has been very weak over the last year. REITs as a whole are down 16%, second worst after communication services. Real estate is highly leveraged with debt, so those higher interest rates rising from basically 0 to up to 5, 6, 7% on a lot of those mortgages, commercial properties, that's going to mean higher interest expense and lower earnings for these companies. Also, those reimbursement rates, okay, a lot of the pay for hospitals, for services, comes from those reimbursements from health insurance, from Medicare, Medicaid, the government insurance programs. That just has not kept up with inflation, okay? Top that off with the higher wage growth from a lot of these professional jobs like nursing, like doctors. There's just a shortage of those workers, and their wage growth growing very quickly in there, faster than a lot of other jobs. That is bringing down earnings for a lot of these hospitals, a lot of the healthcare providers, and the facilities. And of course, that is that fear of hospital solvency is coming down to the property owners. Okay, a lot of these properties, especially MPW in particular, has triple net leases on its properties. Okay, so they own the hospitals, they own the facility, the real estate on which the facilities are attached, and the tenant pays all costs, pays maintenance, pays insurance, pays taxes, pays everything. Just sends a check to MPW at the end of the month for those. MPW has no property related costs, but it still has costs, tenant costs for that solvency. So If a hospital goes bankrupt, like one tenant actually did, Prospect Medical Holdings filed bankruptcy, won't be able to pay a lot of those rents due on those properties, then of course that's a problem for MPW. That's a problem for all of these other healthcare stocks. A lot of these other healthcare stocks, HCA Healthcare, which is a hospital owner, plummeted 19% over the last year. A lot of these others, Global Medical REIT, ticker GMRE, that is another hospital REIT or healthcare REIT, down 43% from its 2021 peak. So this is across the board for not just real estates, not just healthcare stocks, but healthcare property owners. Revenue for MPW was down 7% in the fourth quarter from a year ago. It's only expected to grow 2% on an annualized basis for the next 3 years. So management does not see this environment dramatically improving, at least for the next 3 years. They're probably still going to be under tough conditions for keeping up with those inflation costs, the sales, the midpoint forecast for funds from operations. Okay, that all important FFO number. This is the number you need to track for any kind of real estate investment trust, a REIT, especially these healthcare REITs. That midpoint for that FFO number from management is $1.57 over this next year. That was well below expectations for $1.73 per share. That's really why we saw that steep discount or that steep sell-off in the stock. Now, against all this, though, against that downside, the biggest reason to buy shares of MPW, why I doubled my exposure, is still intact. Okay, the company is paying out $1.16 in dividends each year. That's an 11.5% yield. Even on that lowered guidance in FFO, that funds from operations, the company is still making 1.35 times its dividends in funds. So the $1.16 versus that $1.57 midpoint for FFO easily covers that dividend. A company has a $235 million in balance sheet cash set aside to be able to pay for operations. While that's no guarantee the company isn't going to cut its dividends to preserve that cash, I've seen a lot of companies over the past month, over the past couple of months, cutting their dividend, trying to protect their cash into what could be a coming recession. There's no reason to do it. Okay, they are more than covering their dividend with their funds from operations. My estimates for FFO are actually closer to $1.60 per share. I think the company management is just being conservative with that $1.57 midpoint estimate, and further growth next year makes these dividends easily sustainable. The short sellers have attacked this stock, folks, with more than 26% of the float borrowed and shorted. You can see here statistics on Yahoo Finance. Here you've got this short percentage of float as of February 15th. 26% of those shares borrowed and shorted. It's not alone either. 13.5% of Omega Healthcare, 7% of Sabra Healthcare shorted. It's easily the most targeted of the group, though. That 6.5% bounce in the shares last week could be some of those short sellers taking profits and exiting that attack. But any good news on this stock is going to result in a further short squeeze. One of the places I think that comes from is from the largest tenant of MPW, Steward Healthcare, here, has agreed to sell 5 of its Utah hospitals to Common Spirit here for $685 million. It's going to use that to pay down debt, including a loan from MPW. When this sale is closed, I believe it's going to be a big boost needed to the shares, going to drive that sentiment, going to drive that solvency for the company, and it's going to help drive some of those shorts out of that stock and hit the prices higher. Longer term, again, the company has some very valuable medical properties. Okay, it owns more than 400 medical facilities and the real estate. We aren't spending any less on healthcare services. A major theme over the next couple of decades. That net asset value of the shares. Okay, so the net value of this company, something I love to look at on these REITs, is something you need to learn how to look at on these REITs. The adjusted assets minus liabilities for this stock is $10.2 billion. Okay, that is $17 a share. That means the stock is trading for a 38% discount to its net asset value. I like MPW, these shares up to $15 each before they even start looking pricey. That's why I added that $20,000 in the shares just over the last week. And before I get a ton of comments here, I took a screenshot of my E-Trade account, the news section, and I got to put that in quotation marks because I want to address the question of lawsuits here. A lot of investors are going to rush to the comments, say, what about all these lawsuits that I see for MPW? Okay, folks, whenever a stock drops as much as this one, any stock really, whether it's suddenly or over a period of time, you're going to see all of these, shareholder alerts and investigation alerts through the news wires. Okay, you always look for, these are put out through PR Newswire, through the Dow Jones Newswire service, through Global Newswire. This isn't news. This is these are PR press releases that law firms put out. They pay to put these out. This isn't legitimate news that's picked up by reliable actual news sources, but these PR news wires, things like that, these law firms investigating claims. And again, I got to put that in quotation marks because it's investigating claims on behalf of investors, telling anyone losing money on the shares should contact the firm. And folks, I'm going to try not to go into a rant about how these law firms are just the lowest form of life, and they should actually try doing something productive for society instead of trying to leech off of it. But these are just spam lawsuits. Okay. Again, you see these anytime a stock falls, anytime a stock loses money, lawsuits that pretty much make their living off of investors. They try to sign up these frivolous lawsuits. They try to sign up as many investors as possible in some kind of a lawsuit, a civil suit, try to get a settlement from the company. Okay. Just try to generate as much outrage against the company, try to get a settlement, but they almost never pay anything. Okay. About 99.9% of the time, these are thrown out of court because they are frivolous. Okay. Management has tried to guide this company, has tried to make it profitable. It is just a bad environment all the way around for real estate, and especially for medical real estate. So there was no avoiding this sell-off. Nation, there are law firms that are just making their living exclusively on these spam lawsuits. You see them in every stock that has fallen, just filing to sue any and every company. So it's not how our justice system works. Fortunately, most of these don't pan out, don't cost them a company or investors any money. But just understand that's where that's happening. I want to turn it over to our market update. Some of the stocks I'm watching this week. This doesn't necessarily mean rush out to buy these stocks. I do own some of these stocks. I'm going to tell you which ones, but these are just going to be the stocks reporting earnings this week. Going to be big movers this week. First one here we have Weight Watchers, or WW International, the old Weight Watchers, ticker WW, set to report its earnings Monday after the close, with interesting trading in these shares lately. It's really interesting. Short sellers drove the shares 22% lower in the month to March 1st, so 22% lower after last month, but might have covered their bets here, buying back their short positions Friday, driving at 9.8% higher. Some very strong buying interest in this stock. I don't know if those short sellers are just collecting their profits and don't want to mess with this stock. At these kinds of valuations, it is extremely cheap here. Earnings and subscriber numbers have been extremely disappointing over the last few years. I do own some of these shares. I've owned them over about the last 6-7 months, but the shares have sold off too much. Even on a 14% drop in revenue over the last year, company's still earnings and cash flow positive. Okay, so even in the worst case scenario here, this company, other than a write-off it took in the last quarter, so that write-off did take earnings down into negative territory for the year, but adjusted for normalized earnings, you still have a positive earnings and positive cash flow company priced at just 0.3 times sales. It's extremely cheap. I added another 5,000 shares Tuesday at $3.67 a share, selling the January 24th $5 calls against it just to hedge that risk a little bit for about a $2.89 per share cost basis. Picture with the sectors of the economy. Here we are on sectorspider.com, that sector tracker. Here we can go to the 5-day period to see how stocks did last week. We can see that 9 of the 11 stock sectors did close higher last week. Investors really exiting those safety stocks and consumer staples and utilities, really in favor of that growth and the cyclical names, trying to get back in those faster growth names. Stocks in the energy sector did outperform with a 3% bounce, but are still down about 0.24% this year, underperforming that 5% run in the overall market this year. Again, folks, been talking about this over the last couple of weeks. Energy stocks are just likely to underperform as long as the price of oil stays around $80 or less a barrel. When they start reporting their Q1 and Q2 earnings out in the next couple of months, going to look very weak against last year's earnings when oil was up around $100, $120 a barrel. We do see that stocks in the materials sector have started this year with an 8.9% bounce. We can move this out to the year to date. We can see that stocks in the materials sector have gone up almost 9%, outperforming the market with its 5.3% increase. This is really on hopes that China recovery is going to drive demand for everything from steel to fertilizer, basic materials, any kind of miners, anything like that. Early economic data in January and February was disappointing out of China just because of that, due to a post-lockdown jump in the COVID infection. So late last year, November, December, China removed all of its COVID lockdown procedures after like 2 years of them. COVID infection jumped. I think a lot of people got worried. A lot of people stayed home, but we're now starting to see that confirmed proof that the economy is growing. Over the weekend, China out with its its economic forecast for this year. The government is forecasting or is mandating basically a 5% GDP growth this year. That is going to renew the economic growth in China, and that should continue to boost a lot of these stocks in this sector, in the materials sector, especially copper miners like Freeport-McMoRan, ticker FCX. Looking at economic news this week, not a lot to look at actually until we get to Friday. Earnings have all but wrapped up. 99% of the companies in the S&P 500 have reported their earnings. Very little in the way of economic data until Friday. What I'm thinking though is that is going to give us a very strong idea or a clue into investor sentiment. Okay, if investors can push the market higher, that investor sentiment can remain positive and push the market higher Monday through maybe Wednesday, that's going to be a strong indication of that sentiment, of that investor sentiment. If on the other hand, investors just kind of give up and the market comes down over the first 3 weeks, then no amount of good news for the economy, for the markets, might be able to lift stocks higher over the next few months. On the other hand, again, if investor sentiment remains positive and is able to buoy stocks over the first few days without any other economic data, without any real news or earnings information, then I think that it gives the market a real good opportunity of staying flat or maybe even a little bit higher over the next 3 months as we start seeing the economy weaken. Use the link below to take advantage of that special offer from Seeking Alpha. Save $140 a year on its premium access, or click on the video to the right for the first in our Perfect Dividend Portfolio series, helping you create the perfect dividend portfolio with high yield, safety stocks, and dividend growth names. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.